For 35 years, the Strathmore Hotel Group built a quiet empire. With 8 properties scattered across Scotland and northern England, they employed 410 people and became a cornerstone of the regional hospitality scene. These properties carried serious historic and cultural weight. Take the Salutation Hotel in Perth. It has been operating so long that Bonnie Prince Charlie held his 25th birthday party there in 1745. If you walk into one of these properties today, everything appears perfectly normal. The doors are open, the drinks are pouring, and the business looks exactly like a model of health. That outward stability is exactly why their financial collapse is so jarring. A bustling lobby and fully booked rooms no longer guarantee a healthy balance sheet. On August 11, 2026, Strathmore Hotels officially collapsed into administration, following a winding-up petition from HMRC. The immediate cause of death for the 35-year-old company was cited simply as sustained creditor pressure. They owed money, and the entities they owed it to finally stopped waiting. The real-world stakes of this failure are severe. Over 400 jobs are now at risk in rural and regional communities that rely heavily on these properties for local employment. So how does a beloved, busy hotel group fail? And more importantly, is Strathmore an isolated case or a warning siren for a hidden rot threatening the entire UK regional hotel sector? To answer that, we have to zoom out and look at the broader UK hospitality landscape. After hitting record highs during the post-pandemic travel boom, the market suddenly hit a wall of severe fragility entering 2025 and 2026. Initially, the aggregate data from the Office for National Statistics painted a rosy picture. They reported a 3.6% drop in hospitality insolvencies, suggesting the industry was on its way to recovery. This chart of UK hospitality insolvencies reveals a hidden spike. Tracking the top line, hotel insolvencies increased 7.4% year-over-year. Compare that to the bottom line. Pubs and restaurants saw a 4.4% decline, showing relative resilience. This divergence proves that regional hotels are uniquely vulnerable. They are facing structural economic headwinds that the rest of the hospitality sector is somehow avoiding. The primary threats squeezing these historic hotels can be summed up in 2 words: margin compression. The first pressure comes from the balance sheet. The post-COVID business rates relief has been withdrawn, and that sudden expense has violently collided with the heavy burden of servicing pandemic-era debt. The second pressure is labor. Hotels are fighting chronic workforce shortages, which drives wages up, and this was compounded in April 2025 by a significant hike in employer national insurance contributions. The third pressure is revenue. Comparing operational costs against RevPAR, UK regional RevPAR grew only 1.4%, failing to pace with inflation. Watch these stacked pressures act like a vice. The math breaks as cost bars exceed the revenue line, creating a structural deficit. Ultimately, Strathmore was undone by a broken economic model. In this current financial climate, even a popular regional hotel running at absolute full capacity can find itself losing money on every single room it sells. This brings us to the aftermath and the appointment of Interpath Advisory as joint administrators for the Strathmore portfolio. It is crucial to understand that corporate administration is not the same thing as liquidation. The administrator's immediate goal is to keep the doors open, honor bookings, and trade normally, not to shutter the windows. Behind those open doors, they execute a strategic hotel review. In real time, they cut non-essential costs, optimize staffing levels, and aggressively renegotiate supplier terms. The ultimate objective is to stabilize the bleeding, protect the value of the real estate, and buy enough time to secure a consensual sale to new buyers. Right now, that is the only viable path to saving those 410 jobs. Far from a death sentence, administration is often a strategic, preemptive pause. It's a legal mechanism designed to rescue a viable core business from an unviable debt structure. But the clock is ticking for everyone else. In April 2026, a new business rates revaluation will hit England and Wales, presenting the next major financial hurdle poised to strain the sector even further. Meanwhile, institutional investors are staying cautious. The current market has shifted towards selective, single-asset transactions, led almost entirely by private domestic capital. Unless regional operators can discover extreme operational agility to navigate flat growth and sky-high costs, the collapse of historic 35-year-old chains like Strathmore will become the new normal for the UK hospitality industry.